Welcome to Moving Business Forward. I am your host, Roman Gaida. With me today is John Carroll, Chief Credit Risk Officer of Angst Commercial Finance.
Hi, thanks for having me.
Hello, John. So you're a data and numbers guy. How do you analyze a portfolio and how does credit scoring play into that?
Okay, well, credit scoring is one of my favorite subjects, and it's a very interesting subject, and a subject that a lot of people have opinions about. You mind if I jump on the board here?
Please do.
So the reason why credit scoring is so important is that a risk manager needs a way to be able to differentiate the potential risk of a customer or a transaction.
Okay.
And the better that we're able to predict which applicants that we're looking at right now are going to pay in the future or are going to default in the future, the better that we're able to decision those applicants.
Makes sense.
So what I've drawn on the board here is just a very simple graph. And I'm going to imagine that I've got 100 customers. And I'm going to divide those customers into 10 groups of 10 deciles, so 10 customers per decile. And let's say that these customers have an overall loss rate of X, or overall bad rate of X.
Okay.
So which of the following two risk models is better? I've got a risk model that looks like this. I'm going to call this risk model number 1. Or I've got a risk model that looks like this, and I'll call this risk model number 2. And a lot of people will look at these two models who take the same customers who have a bad rate of X, and they just distribute them throughout the model. And if I say to many people which is the better model, a lot of people will say, well, the blue model, number 1, is better because it's got a lower loss rate. I mean, the loss rate in this red model is really appalling.
Right.
The funny thing is that as a risk manager, this red model is by far the better model. What you want in a risk model is the ability to accurately differentiate future performance. So I want to take all of the losses that come out to this average loss rate of X, and I want to push them down into the lowest parts of my score, which means that this score bands 1 and 2 are going to have a really bad loss rate. Because that way I can identify, here's the high-risk transactions, and here's the low-risk transactions. And the reason why it's important to have a high loss rate here is because it enables me to have a really low default and loss rate here at the other end of the spectrum.
Okay.
And again, this model is accurately identifying who's a high-risk customer and who's a low-risk customer. And then what I can do is I can take these high-risk customers and I can take an action on them. I can decide I'm not going to book those customers. Or I can decide if I am going to book those customers, I'm going to require an appropriate risk structure. I'm going to require more down payment. I'm going to risk price them higher. Sometimes you may say that's a bad thing because I'm charging customers more, but I'm charging these customers what they really should be charged. What that enables me, though, to do is to have really good underwriting on my good customers. So I'm able to take these very low-risk customers and not require down payments, and risk price them at a very low rate. Essentially, I'm rewarding the customers who have proven that they are good credits, and that's really good for everybody. I mean, if you think about your own behavior, Roman, and your own preferences, if you had a mortgage, would you rather have a mortgage at 8% interest because the bank that was working with you didn't have a very good risk model, or would you rather the bank that your mortgage is through recognizing that you're a good credit, recognizing that the potential for you to have a future default is very low, and thus able to give you a 2% rate? Obviously, you'd rather have the 2% rate. So again, the more powerful the risk model that we have, the better we're able to differentiate customers, and thus the better we're able to underwrite those customers. The more accurately we're able to approve or decline those customers, and that's good for the customers. It's good for us as a portfolio because we're able to control the performance of our portfolio. It's good for our vendors because this ensures that we're going to be here for a long time to serve our vendors, et cetera.
Makes sense. So how does risk differ between asset classes? So for instance, between transportation and machine tools?
Well, I'm going to jump on the board again if that's okay.
Okay.
So in general, let me take a step back. One of the great things about ANGS is that we've been here for a long time. We've been in business for a long time. We've been financing machine tools. We've been financing transportation equipment for a very long time. And we have all the data on these various different asset classes. And we've been able to see how these asset classes perform over time, through both good times and through bad times.
Okay.
In general, we've observed that transportation equipment has higher defaults than industrial machine tool equipment. There is some volatility in that. So if you imagine that my blue marker here is going to be the industrial equipment, and let's say you see some volatility, and then I'm going to take this green marker, and this will be the transportation equipment, and again, you're going to see some volatility. On average, my transportation equipment kind of performs like this, and my machine tool equipment performs like this. The interesting thing right now is that we're actually in a very strong economy right now. Overall, the U.S. economy is pretty strong, and as a result, the customers are performing well. Specifically, the transportation economy is very strong right now, and so we've actually seen the transportation customers performing just about as good as they've ever performed. And right now, actually, the transportation customers are performing at close to the same rate as the machine tool customers.
That's great. Well, thank you very much. This has been a discussion with John Carroll, Chief Risk Officer at ANGS Commercial Finance.
Thank you.
Thank you, John.